consider this a higher high. So we can now plot our lower low, and if I just take price back, here we can see that our low that we would be looking at, price went down, it went up, but it didn't break this high. It went down and then it went back up, breaking this high. So this is our higher high and this is our higher low that created that break in structure. Now we can just play price forward and we can see that we have now broken the low, creating a lower low. The high still remains, and then we can just keep playing price forward. You can see we're starting to pull back, and in this case you would be wondering if this is a higher low or if we're going to print a lower high and then continue, especially given the fact that we are in an overall bearish price leg. Let's keep playing price forward. We can see we've broken this high, so we can track our low to this candle right here, and we can plot our high right here. And in this case we actually did break and close above this wick. In the prior example, when we used this high, we didn't actually consider this wick, we actually broke structure down here. So it's a little bit of a smaller break in comparison, but still a break nonetheless. And we can see price then continues pushing to the upside, creates a little bit of a counter trend move. But again, this is all part of the bullish impulsive leg. So we can see we've created a high here and created a true pullback, something that's actually conclusive. And we can see that price is now potentially forming a higher low. You can see right here, we have broken this high with this wick. So this is our new higher high. And we can track back to basically where price pulled back. We can utilize this as our low because it's a prominent swing low of this move. See that price went down, it went up, it went down, and then it went back up. So we can mark this high on here and carry on price yet again. And we can see again that we've broken, and in this case closed above this high right here. So our new high would be right here, and our low in this case would be this candle. As price has gone up, it's created a low and then gone up. See, we've pulled back and we've gone up, so we can adjust that. Pulled back, broken structure again. So in this case we're seeing price tightening up, and like I said, we're getting an actual true pullback versus a situation like this, for instance. That's not a pullback, that's just this wick created a range. This range was filled by these candles, the momentum continued, this wick created liquidity and filled the range with the prevailing candles. Just barely breaks the high with the wick. We can see that price goes down, we go up, we go down. See that on a line chart as well. Smooth it out a little bit, get a cleaner low printed, and just keep playing forward. Now we have created a new lower low and a new higher high. So in these sort of situations, it can throw you off in terms of seeing now we're creating a lower low, but now we've created a higher high. What we can see is we've just set ourselves up for a new low to be created, and then we've proceeded to create a new high and then proceeded to blast off. And like I've said in the initial video, all three methods, they work. They're effective, and it ultimately comes down to what makes more sense to you. You can see that there's pros and cons, all three types. Looking at the first type, you can see that we were able to better understand this trend and not get caught in this large range. But understanding that we were under that range, we can look at the substructure. Overall, keeping in mind the larger bias, but knowing that once we create this impulsive leg, we're more than likely going to pull in some sort of lower high before we start to push down. So we know that price is more than likely going to move to the upside. If I look in the overall 4-hour time frame, you can begin to see it a little bit clearer that we created this impulsive leg and price is now pulling back up. We can see we have a point of interest that we could be looking at to look for sells. So it's only natural that price is going to fill in this inefficiency. It's going to come up, tap this, and if we get buy-ins from institutions, that would be where we would start to see price drop again. And we can see that we broke structure here, whether we look at this point or this point right here. We can see that we also have a point of interest that price tapped into, which is why this leg right here was created. We can see that reaction right there. We can see that we created this range overall that created a lower low, and this is our high here. Price then pushed down, and because this was a momentous move that broke structure, we have an order block on the 4-hour that we could be looking at for sells. We can see price taps into it with a wick and then pushes down. We can see that This move created a lot of inefficiency on the 4-hour, which needed to be filled, which is why we're starting to see a pullback overall on the 4-hour chart, and we're able to look at that in a little bit more detail on the 1-hour chart. And again, we came to the same conclusions overall using the different types of market structure. The only variance with being number 2 and number 3 was that we had to essentially utilize substructure to be able to accurately identify this bit of price action, whereas with number 1, because we were using the bodies, we can see that price allowed us to just follow that trend overall. And then a final remark when it comes to market structure is understanding that market structure is a tool that we use to understand what is happening and frame our trades. We're not trading market structure directly. We're using higher points of interest to understand when we see market structure breaks, and we can see right here, for instance, price did break this, but if we were looking at it in a different light, we can see that we created a high here with method 2 and 3. We can see that price impulsively moved to the upside. And if we were using method 1, we'd see that we put in a higher high and a higher low. We then broke down and basically printed a low down here. Our high would be right here. Then we started to switch bullish again and push to the upside, basically creating higher highs and higher lows. We broke structure down here, and we can see that this was the start, and we've identified the order block. If we look at method number 2, we can see that price created a high. We broke that high here, creating higher highs and higher lows. We didn't necessarily break the high here, we just wicked it. We would have had a low right here. We broke that low. We can identify the order block still in the same light. And then finally, if we go to method number 3, we created a high. We broke that high, creating a higher high with the wick, which would denote this is our low. We would have this is our high. We can see that price broke this low. This would be our new high. But then we created this low. We broke it. So this would be our new high. We can see that we broke here, this candle, this low here. So our new high would be here, and we can see that we broke. This would be our new high. Our new low would be right here. You can see that we then created a high here that broke with this candle. Our new low would be here. We broke that high there, created a low here. We get this sort of candle maneuver where we pull back, but we also create a new high. So this would be all part of one price leg. We create a high, just barely break it. You can see if I zoom in just a little bit, we can see that we break it with this candle right here. So our new low would be right here. We get a break of market structure and a move to the downside that breaks many lines of market structure. We are able to identify our order block. So either way, it doesn't matter which way you are identifying market structure, you still come to the same points. You get to the same point of interest, especially when you look at this large impulsive move to the downside. You can see that we have that overall order block that was created in this point, which we'll be using as our higher time frame point of interest. And then we see price taps into it and continues to sell off. And we're still utilizing market structure regardless of the type of identifying how we're mapping the structure and how we're identifying the breaks of structure. We still get to the same result. We can see that price is still creating higher highs and higher lows. We break structure, whether the structure is down here, it's up here, or it's up here. We identify the order block because we've broken structure. We've seen the momentum jump into the markets, and then we would still be looking for price to retrace back to that order block and then continue to the downside. So I hope this video has helped clear up any confusion that you may have had surrounding the highs and the lows. And I urge you again to backtest, figure out which method makes more sense to you. They can be a little bit confusing initially on how you want to identify highs and lows and how you want to identify breaks of structure. Depending on where you are in your Forex journey, you may have learned different ways of doing it, and I urge you to pick, again, the method that makes the most sense to you, because at the end of the day, you're going to arrive at the same result regardless of how you're identifying market structure, because you're going to still be able to identify the higher time frame points of interest that we should be identifying in order to find trades, because we are trading order blocks and using inefficiency and market structure to understand where price is more than likely going to pull back to and react off of before moving in a certain direction. And then we can frame out trades and utilize market structure to understand those moves and just classify and categorize those moves into an understandable framework.